Hello, everyone. Thank you for joining. We'll get started in just a couple minutes to allow everybody to dial in. Okay, welcome everybody. Welcome to the 2018 storm season predictions and protections presentation. We're very happy to have you. Just one quick housekeeping item before we get started. You're welcome to submit written questions throughout the presentation, which will be addressed during our Q&A section at the end of the presentation. To submit questions, or if you have any technical difficulties, please use the Q&A box to the left of the slides on your screen. So thank you all for joining us. My name is Cole Mayer. I'm with our Innovative Risk Solutions team here in North America. Our team gets involved in a number of different transactions that involve unique or different structures or triggers that don't necessarily fit neatly in a traditional line of business. That includes parametric, so we've seen a lot of great traction on the parametric side, so we're very happy to have you here. Alongside me, we have Kirsten Orwig, who is a NatCat specialist on our Corporate Solutions North America property team. Kirsten holds a PhD with a background in atmospheric science and wind engineering. And Kirsten was formerly with our Cat Perils team and helped develop our current suite of wind risk assessment models. So you're in very good hands with her here as well. So from an agenda perspective, we'll start with the predictions piece of this. So what factors are critical for hurricane development? How reliable are the seasonal forecasts that you see? And what are the experts predicting or projecting for 2018 hurricane season? And then we'll get into the protections piece of this, specifically talking about parametric insurance. What is it? Swiss Re's view or method for how we typically structure parametric transactions, and then the benefits for the various insureds and clients of our particular method on the parametric side. And then we'll leave 10 minutes for Q&A, so we're looking forward to that as well. So without further ado, Kirsten, I'll kick it over to you.
Thank you, Cole, and thank you everyone for joining in today. We really appreciate it and hope you find a lot of useful and beneficial information from today's presentation. So I'm going to start off by talking about how hurricanes develop, what's important, what do they need. And first of all, they need energy. And this comes in the form of generally sea surface temperatures. In the Atlantic region, the sea surface temperatures, if they're greater than generally 80 degrees Fahrenheit, that's deemed to be favorable for hurricane development. Likewise for the Gulf of Mexico and the tropical Pacific region as well. We also need to have humidity or moisture in the atmosphere. This provides the moisture to develop clouds and also to develop storms that are needed to for the hurricanes to intensify. Additionally, we need something called instability. So off of the coast of Africa, we get these easterly tropical waves that move across the Atlantic Ocean, and they create areas of instability and storms where you have warm air rising developing clouds, and this helps to intensify and increase the potential for hurricanes to develop within the Atlantic Ocean. We also need low wind shear. And what am I talking about when I mean wind shear? So we need to have the wind speeds throughout the atmosphere. The difference between those wind speed layers needs to be relatively low, so less than roughly 20 knots. And if there's significant differences in direction of those wind speeds, then that also creates additional shear. This tends to tear apart storms and prevents them from developing or intensifying further. So we need a certain level of tranquility within the main development region for hurricanes to develop. There are also a number of regional climate patterns that have been shown to favor or to prohibit tropical cyclone development in the Pacific and the Atlantic. The key one you may be familiar with is the El Niño-La Niña, or ENSO, pattern, which relates to the sea surface temperatures of the tropical Pacific. When you have warmer than normal sea surface temperatures, you have an El Niño phase. When it's colder than normal, then we have a La Niña. And this tends to directly affect the activity levels, particularly in the Pacific, but it also affects the activity in the Atlantic. When you have an El Niño in place, this causes a lot more wind shear across the main development region of the Atlantic. So this tends to reduce the amount of activity. However, if we're in a neutral phase or a La Niña phase, this tends to reduce the amount of wind shear over the Atlantic and can lead to more developments. Another pattern you might be familiar with is called the Atlantic multidecadal oscillation. This is also related to sea surface temperatures and has to do with whether the temperatures are warmer or cooler than normal over the North Atlantic for an extended period of time. And we've been in what's considered to be a warm phase since roughly the mid-1990s. So this provides a lot more energy for storms to develop over the Atlantic region. Another pattern that tends to influence whether storms make landfall is called the North Atlantic Oscillation. This is essentially a coupling of a high pressure system and a low pressure system over the North Atlantic. You may have heard of the Azores High or the Bermuda High. This is what that's referring to. When the high pressure and low pressure are stronger, we have a positive NAO index. When it's weaker, then we have a negative NAO index. This index, however, doesn't provide any indication of the position of the high or the low, and these can shift from east to west. And it's this shifting pattern and the intensity of the high pressure system that really affects where storms will track. If we overlay the historical tracks that we've had on the map, you can see that there is a lot of different behaviors. Some of them move more east to west, where others tend to curve off to the northeast. So why does this happen? Well, when you have a positive NAO index, this means that the high pressure system is fairly strong, and it also increases the steering currents
Hello, everybody. Sorry about that. It looks like we may have lost Kirsten, her audio here, so we'll get that up as quickly as possible. In the meantime, I'll go ahead and get started on the parametric side of the presentation, and hopefully we can come back to Kirsten in the end. So apologies for the technical difficulties there. So I'll move forward to the parametric piece here. Okay, so again, hopefully we'll get back to let's get back to the correct slide here, and hopefully we'll get Kirsten back on the slide. Okay, bear with us one second, guys. Sorry about that. Okay, let's move on to the parametric section again. Thank you for your patience here, everybody. Thank you for that. Okay, so on the parametric side, what is a parametric insurance product? So after sort of hearing some of these predictions, hopefully we'll hear the rest of them here pretty shortly, but what do we do about it from a protection perspective? So one option is parametric insurance. So what we're really trying to do with a parametric insurance product is pre-adjudicate a claim as best we can. And the way we do that is through a predefined set of event triggers and payout factors associated with the event. And the way that we settle these transactions are based on the event parameters rather than the actual loss sustained that you see on the traditional side. Okay, so in terms of the steps of the transaction, the first piece is defining the triggers. So those are key, obviously, in the adjudication of a parametric product and cover. We would then bind the policy, so fairly simple there. The event occurs, and then we determine, based on the pre-agreed event thresholds as well as the payout factors, what payout is associated with that event. We release the payout typically quite quickly, usually within 30 days, sometimes sooner. And then an important piece of this, the last piece, the loss confirmation piece of this. So this involves the insured effectively certifying to us that indeed the losses that they suffered were at least as high as the payout. So in other words, they didn't make a windfall profit on the transaction, which allows us to call it insurance from a regulatory and tax perspective. So very quickly looking at traditional versus parametric insurance. We'll have another slide here as well on the next slide to go through the various points in more detail, but in summary, traditional insurance, as many of you know, is indemnity-based. So it's based on the actual loss sustained that the insured suffers as determined by the claims adjusters and the boots on the ground. Typically, it's going to be a physical damage trigger, so physical damage, direct physical damage of the type insured, and the BI associated with that. Parametric covers, conversely, are based on the event parameters, as we covered in the previous slide. So the cover is triggered if those predefined event parameters are hit. It doesn't necessarily require physical damage at the insured site. So it's a bit broader in terms of the types of losses that are typically covered with these parametric transactions, which allow a bit more flexibility in how they're used. And we'll get to the benefits here in a few minutes. So the key is, again, traditional are indemnity-based, actual loss sustained. Parametric are event-based, so they're based on the event parameters. So I'm a large property guy by trade and by background prior to this role, and so sometimes it helps me to sort of frame parametric and understand parametric in the context of traditional and how they're different. So we'll go through these just briefly, and hopefully this will give you a better sense for how parametrics are fundamentally different. So from a trigger perspective, as we've alluded to before, on the traditional insurance side, The trigger is direct physical loss or damage to a physical asset, typically the insured's physical asset. On the parametric side, it's the event exceeding a predefined threshold or trigger. So fundamentally different trigger there. From a recovery perspective, it's the reimbursement of the actual loss sustained on the traditional side, again, as determined by claims adjusters post-event. On the parametric side, it's pre-agreed the payout structure and the event parameters, and that is what defines the payout and the loss payout at the end of the day. So basis risk, an important point to touch on. So basis risk, the term is effectively just the risk that the payout that you get on the insurance side from the insurance cover is different from the loss that you as the client suffers. And there is basis risk on both sides, on the traditional and parametric. On the traditional side, that basis risk comes in the form of policy conditions, deductibles, sublimits, exclusions. So anything that might limit the payout that the insured gets relative to the loss. On the parametric side, the basis risk lies in the correlation between the trigger structure and the actual exposure. So if you remember, what we're really trying to do is pre-adjudicate the claim, if you will, and so in doing that, there's a bit of guesswork that goes into determining the triggers relative to the projected loss that the insured might see at a given payout threshold or wind speed threshold in this case. So there could be some variation there. We work very hard in conjunction with the insured to design these triggers such that we minimize that, but important to understand the basis risk on both sides. The loss assessment and payout, it can be fairly complex on the traditional side depending on the complexity of the loss. BI and CBI losses tend to be a bit more complex and difficult to adjust. On the parametric side, one of the key benefits is quite a transparent and relatively easy settlement. Again, typically within 30 days, sometimes even quicker than that. So that's one of the key benefits on the parametric side. The term typically annual on the traditional insurance side. Parametrics can be annual. Very frequently, they're multi-year, 2 up to 3 years typically. So a bit more flexibility than you might see on the traditional side. The structure is quite standardized on the traditional side. You might get some variance, manuscript forms versus company forms, for example, but the standard products are fairly uniform in nature. These parametric transactions are quite customized, so there's a lot of flexibility. One of my colleagues has a great analogy. It's a bit like a bespoke suit. So we work very closely with the insured to develop a suit, or a highly tailored suit, if you will, to their exposure. And finally, the form, these are both done on an insurance basis. So some of the key features of parametrics generally, and then we'll get into how Swiss Re looks at parametrics. So one of the key pieces of any parametric transaction should be an independent data provider. So a provider that's dependable, that provides a good granularity of data, and that cannot be influenced by either party in the transaction. So a couple examples might be the National Hurricane Center, RMSH wind, which we'll get into in a bit when we look at Swiss Re's specific approach, but very important to have that piece in any parametric transaction. The timing, a quick payout, as we alluded to on the last slide, to assist with immediate financial and liquidity needs. Insurance form, so these can be done in an insurance form from a regulatory perspective and a tax perspective. As we alluded to earlier, the loss confirmation component is what allows that to happen. The broad coverage, so from a parametric perspective, typically the bucket is a bit bigger in terms of which losses can be considered losses under the contract, so it's fairly flexible in that regard. Typically any direct or indirect financial loss as a result of the event. So that could be, there's a couple listed there: business expenses, increased supply cost, obviously loss of revenue, either direct or contingent, so quite broad in terms of what it covers. and there is no deductible on the parametric side. So it's effectively if the event threshold or the event parameters were met at a given payout threshold, we would pay. Okay. So how does Swiss Re specifically look at parametric transactions, and what is sort of our preferred method going forward? So we call our preferred method Swiss Re Storm. Quite a good name, I think. But it's just our sort of unique take on how we structure parametric windstorm transactions. So there are many ways to structure. This structure in particular defines certain trigger locations that mirror the insured's exposure, and then pays based on the wind speed at each of those trigger locations. So the idea really is that we're paying based on the wind speed that the insured sees at their sites specifically. So the basic steps involved in structuring this are step one, we define the trigger location. So this is critical. Here we look at the insured's exposure, for example, a schedule of values typically, and we define the trigger locations based on the insured's exposure. So a couple examples might be a lat-long trigger location at an insured site specifically. For larger, more distributed portfolios, it might be zip code centers for bigger schedules. But the idea, again, is to define these such that it replicates very closely the insured's actual exposure. Step two would be allocate limits to each trigger location based on the insured's exposure. So for example, we could allocate that limit proportionally by TIV at each of the trigger locations. A number of different ways to do that, but the idea again is to mirror the insured's exposure both by the trigger locations and by the allocation of limit as closely as we possibly can. Step three would be to define what we call the payout table. So this determines the payout by wind speed at each trigger location. So for example, that could be 20% of the limit at a given trigger location at a 75 mile an hour, 1 minute sustained wind speed, and then a 40% of the limit payout at 85 miles per hour, 1 minute sustained wind speed. So, and you'll see an example of this in a couple slides, but very important to determine the event thresholds and the corresponding payout that we talked about earlier. And we work with the insured to find a payout table that, number one, makes sense given their loss experience and their exposure and the vulnerability of that exposure, and two, fits within the insured's budget that they have to spend for this particular cover. So step four, quite simply, is to bind the policy. Step five would be the event reporting piece. So after a named storm occurs, after we've entered into the contract, we would receive a high-resolution wind footprint from RMS H-Wind, and I'll talk briefly about what RMS H-Wind is, but that they're really, in our view, the best science, most granular science in the field. And once we get that, that allows us to determine the wind speed experienced at each trigger location. So once we have that, we're able to quickly apply the payout table to each trigger location, looking at the reported wind speed at each trigger location, and we process a payout accordingly. Step seven, finally, is that the insured verifies their event loss, as we talked about. That's that loss confirmation piece. Okay, so here you can see a sample payout table. So what we're looking at here, we have 4 trigger locations. You can see the TIV there. You can see the parametric limit and how it was allocated. So it's a total limit across the 4 trigger locations of $5 million. You can see the parametric limit, excuse me, for trigger location 1 is 1.75 million, for 2 is 1.25 million, and so on. And you can see the payout table here. So the payout table for is those last 2 columns there. From 96 miles per hour, 1 minute sustained wind speed to 110, you get a payout of 50% there. So 875,000 for the first trigger location, 625,000 for the second, etc. And then 111 miles per hour, 1 minute sustained wind speed or higher, you get the full 100% payout for each trigger location. So the idea is that if at any particular trigger location the wind speed is between 96 and 110, per RMSH wind, we would pay that particular limit for each trigger location. If it's 111 or higher for each trigger location, we would pay that 100% limit, and then we add all of those together, and that is the payout at the end of the day. So here's a quick look at the sample terms and conditions that we might have for a given transaction. So obviously the cover is parametric name windstorm insurance. The term could be up to 3 years. That's flexible depending on the insured's desires. From a limit perspective, the limits here would apply by exposed zip code. So here we would define, for example, the trigger locations as the lat-long center of each zip code, which would match up quite well with the insured's exposure. And then we have a per event limit and a term aggregate limit. The triggering event, again, would be the wind speed per exposed zip code. And we saw the trigger details on the previous slide. And then we would develop a per annum and term premium associated with this particular cover. Okay, the benefits of storm and of parametrics more broadly. So why do parametric insurance? So there's a couple key advantages, and I think this graphic summarizes them quite well. One way to sort of look at this is the time it takes and the steps through which the insured gets paid. And so obviously you can see on the top there is the indemnity-based insurance process. So there on the bottom axis there is the time it takes. So the event occurs, and obviously a number of steps on the indemnity insurance side in order for the insured to get paid. And by the way, we do a lot of traditional insurance, and often it makes sense, and so we're certainly not disparaging it in any way. But there are a number of steps that are required in order for the insured to be paid, and for some insureds with some exposure, they require a shorter timeline, a shorter process, and require immediate liquidity to be able to continue their operations. And so that's where parametric insurance can really help. So you can see there on the bottom screen there, the event occurs, the intensity is verified, and the payout is processed, as we've alluded to before. So you see at the very end is that confirmation or proof of loss, if you will, at the very end, which is necessary essentially to include this or consider this as insurance. So the key drivers, I want to spend a few minutes on this slide because I think for many of you in the audience, this is going to be sort of the most important slide in addition to understanding what parametrics are, is how can they really help you as an insured or your clients on the broker side. So one key area where parametrics can really help is to protect against indirect economic loss. So very often there are exposures, particularly on the NatCat side, that the insured cannot necessarily get traditional insurance cover for. So those might be some contingent exposures that don't necessarily fall in their definition of CBI, or they're broader than the traditional CBI cover. So there's a lot of flexibility that the parametrics have to cover a number of different indirect economic losses that can supplement the coverage that you have on the traditional side. And so that sort of leads us to the next piece, which is supplementing traditional insurance. So very often we've seen insureds use parametrics in conjunction with their traditional cover. So it's a great way to supplement, for example, a relatively high natural catastrophe deductible on the windstorm side, for example. It could also help fill the gaps in limits, exclusions, et cetera, in the contract that, again, sort of increase that basis risk that you have on the traditional side. And so parametrics can help to supplement that a little bit and fill in the gaps that you might have on your traditional catastrophe tower. Parametrics are also great for covering either underinsured or uninsurable risk. So one immediate example that comes to mind that we see quite some traction on is transmission and distribution lines. So that's a pretty much a standard exclusion on the traditional property side. Very, very tough to cover due to the vulnerability of the risk. But because parametrics are event-based, event parameter-based rather than actual loss sustained-based, we have the flexibility to cover some of those types of exposures that don't necessarily lend themselves very well to traditional insurance cover. So very important point there. That fourth point on the top right there, the quick payout. So we touched on this a number of times, but important to talk about again. Many insureds, take a hospital, for example, need to stay up and running, need emergency equipment, generators, et cetera, right away. And often it's difficult for them to get their claims paid in a timely fashion such that it can cover some of those immediate costs and immediate liquidity needs. And that's where parametrics can really help, again, as a standalone or to supplement your traditional insurance tower as well. So that quick payout, a very big advantage on the parametric side. So simple and transparent claims. We talked about the claims adjudication process. It's really where the event parameters hit and we pay, and then there's a loss confirmation concept that's quite simple. It's effectively just the insured attesting that the loss met or exceeded the payout. So very simple and transparent claims process there. And finally, it can assist with post-event costs. So we talked about that in the context of a quick payout or improving the liquidity position right away post-event. Okay, so what I'm going to do, I'm going to go back to Kirsten's presentation. Kirsten, are you on the line now?
Yes, can you hear me?
I can, yes, absolutely. So I'll let you
Excellent.
take control and you can go back and we'll have a few minutes and then we'll go to Q&A here in about 20 minutes or so if that works for you.
Okay. So apologies for the technical difficulties there. Hopefully we can stay connected long enough with no other issues. So I'm not sure exactly where I dropped off, but I'll start off talking about the Saharan air layer. This is just another factor that can influence the hurricane activity within the Atlantic in particular. There's still a lot of research in this area, how exactly it influences the activity, but it's pretty clear that there is some influence there. So going forward, how reliable are these seasonal forecasts? We start seeing them coming out now, in April, and sometimes even a little bit earlier. But are they even really reliable? First, it's worth talking about the climate patterns that I mentioned earlier in the presentation. The El Nino Southern Oscillation Index, or the El Nino La Nina pattern, this typically isn't very well forecasted beyond 6 months ahead. Additionally, there's limited forecast skill in the springtime. This is also an area of active research why this is, but it's generally believed that it's due to kind of a decoupling of the ocean atmospheric processes during the spring transition months from winter to summer. And the models just aren't able to fully capture that decoupling to forecast the El Nino La Nina pattern when it's in the spring. Additionally, the Atlantic sea surface temperatures, there's pretty good skill up until about 8 months ahead in the tropics. However, there's limited skill in the mid-latitudes just due to influences of, for example, the North Atlantic Oscillation, which could influence the sea surface temperatures in the mid and North Atlantic. Additionally, the NAO itself, generally forecasts are reliable up until about 2 weeks ahead, but beyond that, you're better off flipping a coin. And the Saharan air layer, it transitions fairly quickly over a matter of days, and forecasts for that are generally unreliable beyond a few days. So really, kind of the predictability of these cloud patterns really depends on the amount of lead time. And when we're talking making projections 6 months in advance for hurricane season, it's extremely difficult because a lot of these key patterns that will influence that activity, there's still a lot of variability, and the forecasts for those climate patterns may not be all that reliable themselves. So we have a number of agencies now that are putting out seasonal tropical cyclone forecasts. The probably most weighted for forecasts is generally issued by Colorado State University. They've been issuing these outlooks for the Atlantic region since the 1980s and have developed a pretty good track record over that time. Some other agencies here are either NOAA, federal government, or other universities, but also a number of private agencies that have started developing these outlooks within the last 5 to 10 years. If we take a handful of these agencies and look at how they performed over the last 5 years for named storms, so these are storms that have reached tropical storm strength or stronger, we can see that they're generally okay. There's about a 7% correlation between observed and the named storm forecasts over historical seasons. And this kind of shows up here with these particular agencies. When we talk about hurricane forecasts, though, there's quite a bit more variability and less reliability. You can see in 2013, that was kind of a big bust year in the forecast. All of the agencies shown here were predicting somewhat of an active season, between 8 and 9 hurricanes to form within the Atlantic, and all the ingredients were there. It was a La Nina, so there was low wind shear in the Atlantic. We had warmer than normal sea surface temperatures. We also had very active easterly waves off of Africa. So all of the ingredients seemed to be there. But there were some extratropical some additional atmospheric influences that increased the wind shear within that main development region in the Atlantic and resulted in only 2 hurricanes that season. Also, 2017 was also a little bit of a bust year. It was expected to be lower or slightly lower than average based on the forecasts around this time last year. And instead, it turned out to be very active with 10 storms overall. Major hurricanes are even more difficult to predict because there are a lot of specific influences that affects whether hurricanes will actually intensify into major storms of Category 3 strength or stronger. And these influences are extremely difficult to predict several months in advance. And so we can see that the hit ratio for major hurricanes is quite low over recent years. All right, so what are the experts projecting for 2018? Well, it's hard to say. The forecast range, if you look at kind of the overall range of all the forecasts that have been issued, it's from 7 to 18 named storms. This includes subtropical storm Alberto, which we already had at the end of May, early June in the Atlantic. 4 to 11 hurricanes, and 1 to 5 major hurricanes. And you can see how this compares with the median number of storms over the 1981 to 2010 period. In general, if you look at Colorado State, who's been doing this for, several decades, they're expecting kind of a near to perhaps slightly above the median in terms of activity. But in general, most of the agencies are predicting within kind of a near median activity. There are a few exceptions that are predicting lower activity, such as Penn State and the UK Met Office, weather bell, and tropical storm risk. So there is quite a bit of variability in the forecasts. What are the key considerations for this year? And this tends to be kind of a common consideration from year to year, largely due to the uncertainty in the climate pattern forecasts that I talked about earlier. Right now, we're in an ENSO neutral phase of the El Nino-La Nina pattern. However, it's projected that a weak El Nino will develop by the August-October timeframe. And you can see the different forecasts on the top plot on the right. Anything above 0.5 sea surface temperature anomaly would be an El Nino. Anything below a negative 0.5 would be considered a La Nina. So we can see that most of the forecasts are suggesting that a weak El Nino will develop by the main hurricane, or the peak hurricane season. So for the Atlantic, that means potentially increased wind shear that would reduce the amount of hurricane development in that region. However, on the flip side, because you have a lot more energy and a lot more heat to work with in the Pacific, it's likely that you'll have increased activity in the Pacific region. Additionally, the Atlantic sea surface temperatures right now are showing kind of an atypical pattern for a warm AMO phase. What we see is kind of this horseshoe pattern where you have really cold sea surface temperatures up around Greenland and Iceland in the far North Atlantic, and then also cold temperatures down in the main development region in the tropical Atlantic, shown in the red box. This is also associated with very, very warm sea surface temperatures off the eastern seaboard of the U.S. This is somewhat atypical, but this is a pattern that we've seen over the last few years about this time of year. It is forecast right now that the tropical Atlantic will warm somewhat over the next few months to roughly a near normal sea surface temperature through October. If this happens, this could provide enough energy to increase the level of activity, but it also depends on how the El Nino will develop. If it ends up being cooler than normal, then we can expect this to suppress development, except perhaps along the eastern seaboard and the Gulf of Mexico. So what this suggests is that if storms develop and they're able to maintain themselves and intensify, and assuming that the North Atlantic Oscillation that we talked about earlier continues to stay in a positive phase, which we've seen over the last few months, this would suggest that there's a stronger likelihood of landfalling tropical cyclones for this year. And with that, I will hand it back over to Cole.
Great, thank you, Kirsten. So it looks like we have about 5 minutes until our slotted Q&A. We have a number of questions in here. I thought I might go just briefly now that I know we have time, and thank you again to the audience for putting up with our technical difficulties. Apologies for that. But I thought I would go in briefly in the next couple minutes to parametric structures that you may have seen or might see in the future out in the sort of landscape. So one would be a cat in the circle. So that's obviously fundamentally different from our storm capability that we went through earlier. Fairly common, and that's been in the marketplace for a number of years now. So the idea is you pick a point and you draw a circle around it, and if the center of the eye of the storm pierces that circle, and then subject to the payout structure that you establish, it would pay in accordance with that. So fairly simple structure and they work reasonably well for some exposures. There is sort of the downside, the hit or miss potential, if you will. There is a bit of, the track could track slightly outside of the circle, but you still experience significant wind speeds at your site. And that wouldn't trigger a payout, unfortunately. And so you do have a bit of a hit or miss potential with cat in the circle that you don't have with our storm product, because from our perspective on the storm side, with the wind speed exceedance at specific trigger locations, the cover doesn't particularly care what shape of the storm, what direction it took, etc. All it really cares about is the wind speed at those specific trigger locations that mirror your exposure. So the cat in the circle is something you will likely see out in the market if you're looking at parametric transactions. Again, it's not a bad structure. It's just there is a bit of hit or miss potential that you don't have with the storm product. Another one you might see out there is anemometer based. Again, they can be quite useful. So anemometers, just a little bit of background, effectively measure the wind speed at a given site. And though there are many networks, NOAA has networks as well as some other private companies, and again, can be useful. The potential downside is they can fail. Obviously, hurricanes can generate some pretty significant winds and debris associated with that, and so you need to be a little bit careful with that. On the storm side, from our perspective, RMSH wind, which we talked about earlier, uses many different data sources, and so it really won't or can't fail to give you a wind speed report at a specific trigger location. But again, anemometer base can be fine from a structure perspective. Just need to be aware of some of the potential downsides. Okay, with that, it looks like we're about at our Q&A. So what I'm going to do, feel free, audience, to load in your questions in the Q&A section. So we have a number of them already, so I'll go ahead and answer as many as I can, and feel free to throw in more as they come to you. So one question is, it looks like we have a number of questions on the loss confirmation process and various sort of attributes of that. So I'll get into that just a little bit. So it's quite an easy process. Effectively, it just requires sort of initial notification that the insured feels a loss may have occurred under the cover. And then 12 months later, it's really as simple as the insured signs a document stating that the loss is met or exceeded the payout. So we're not sending boots on the ground. We're not looking at receipts. We're not counting broken dishes or crumbled walls at your specific site. It's really the insured attesting that yes, the payout did in fact, or the loss rather, did in fact meet or exceed the payout. So that's really important. I'll get into briefly why we do that. So that's very important from an insurance regulatory perspective. So on the insurance side, in order to be considered risk transfer and to be considered insurance, there can't be the possibility for a windfall profit, which you could theoretically have with a pure parametric transaction. And so in order to count this as insurance, we need that loss confirmation component in order to effectively facilitate that risk transfer. So another question I'm looking at and seeing here, if the insured cannot confirm the loss exceeded the payout, would the insured need to pay back the difference, if you will? So the short answer is yes. So again, that basically eliminates the possibility that there's a windfall profit from this particular transaction. I'll say a couple things on that front. So one is, considering the typical limit of ease and the broadness of the cover. So we talked about, with these particular transactions, the insured can throw a lot of their loss in sort of the bucket, if you will, of the loss under the parametric cover. And so, it's quite broad, such that we feel, combined with the limiting, combined with sort of the bespoke nature of the transaction, we work very closely with the insured to design these triggers, and that includes the limit, such that we feel we minimize pretty well the probability that we'll have to collect back funds if the payout is higher than the loss. But that is a component that is there, and that you should be aware of, in sort of the context of that loss confirmation piece. Okay, so hopefully that answered a few of those questions there. So I'm seeing another question relating to parametric insurance for other perils. The short answer is yes. The question was, are these available for earthquake, potentially for flood? So yes, they are absolutely available for earthquake. So we have, in fact, have a product that we call Quake. So similar to storm, it's called Quake, using the USGS shake maps. So we feel very excited about that particular product. Unfortunately, didn't have time today to go through it in detail, but structured in many ways similar to the storm product, in that it utilizes trigger locations to replicate as best we can the insured's exposure and the actual shaking, the intensity of the back and forth shaking at those specific trigger locations. So for earthquake, it's absolutely available, and we see a lot of traction, particularly on the West Coast, to a lesser extent in the Midwest, but everywhere from an earthquake perspective. Okay, so let me move on here. I see one question relating to historic buildings. So can this be used for tough to insure properties like historic buildings? So great question. And the short answer is yes, absolutely. And it can be a great way, as we talked about earlier, to cover exposures that are very difficult or very, very expensive or prohibitively expensive to cover in the traditional side. So as we know on the earthquake side, it can be quite difficult and quite expensive to insure historic and very old buildings for a number of different reasons. Because the parametric transactions, and either on the earthquake side or on the wind side, this could apply for both, because the parametric transactions care only about the event parameters and not necessarily the underlying risk. We do use the underlying risk to set those triggers, to help set them, but once they're set and the cover is agreed, it's really only based on the event parameters. So it allows us to insure what on the traditional side might be considered uninsurable or very, very difficult to insure. So great question. Okay, so another question coming in. Hurricane season has started. Is it too late to explore a parametric solution in 2018? Very good question. No, it's not. So obviously, wind season started on June 1st, but we're seeing quite a steady influx of additional opportunities and requests to look at parametric transactions. So while wind season has started, obviously it goes through to the end of November, as Kirsten can attest. So no, we're more than happy to have those conversations. It's a little bit difficult if there are obviously storms brewing sort of as we're having these conversations, so we can't cover storms that are in process at the time. But we can certainly have the conversations past June 1st and including right now and in the coming months.
And Cole, we have a question regarding the last hurricane season, whether there were any losses arising from parametrics during Hurricanes Harvey, Irma, or Maria.
Sure. Good question. So we did pay out some losses. So I'll give you one example. So one was Hurricane Maria in Puerto Rico. So actually a really great story, we feel. So it obviously Maria, devastating event for Puerto Rico specifically, and for obviously commercial and government interest there. So we had a parametric structure in place there, and it ended up paying within, I believe it was 14 days in accordance to the payout structure. So so just one example, we have paid on a number of these now. They've been sort of tested in the market, but one example of the quick payout, particularly, and getting the insured liquidity when they needed it post-event. And as we know, it was quite devastating in Puerto Rico to the infrastructure there. And so very happy that we could get that quick payout and quick liquidity to the insured to help get them back up and running as quickly as possible. Okay, so another question, compared to traditional insurance, how does the rate behave on this? So good question. Fundamentally different when we talk about rate and how we rate these. So typically when we're talking about rate on the traditional insurance side, it has to do with a rate that you apply on the insured value. So on the parametric side, obviously, it really the event parameters are set, and that's what we pay out on. And so we don't particularly, again, care from purely a parametric perspective what the underlying value is. So we don't typically look at the rate on the underlying value. A very rough ballpark in terms of if we were talking about rate online, so the premium divided by the limit that is associated with these structures is 3 to 5% rate online, roughly. Now the normal caveat here, that can vary widely one way or the other depending on the exposure, depending on where it is, depending on how sensitive the payout thresholds are. So certainly take that guidance with a grain of salt, but that's just sort of a very, very general rule of thumb when you're looking at sort of how much can I expect to pay for these types of parametric transactions. Okay, so with that, I think we're approaching the end of the call, and if there are any unanswered questions, apologies. I know we had quite a long list here, but we'll get a list of questions at the end, and we're more than happy to reach out with answers. And by all means, feel free to reach out to any of the team members. Myself, we have a very experienced team on the Innovative Risk Solutions team across the United States, and I'm sure Kirsten is more than happy to answer questions as well. So with that, I'll close the call, and thank you very much for the time and for listening.